UPS Tuesday before open. Generally, they beat earnings. They have a huge line of just green beats. A few misses here and there from time to time. Got a bit of that market cycle look to it, but it's too early to tell if we've seen a real selling climax and we're getting into Wyckoff accumulation just yet. Stacks does have a March 2026 105 put for $542,000 taken out on Friday, but there's not much else recently. Overall, still bearish, but I can't imagine that this name will bleed out too much longer if so. Their PE is at 14.96, so keep that in. That's pretty low in terms of some of these bigger names. We usually do see closer to 20 when it comes down to a PE ratio, and especially during times of euphoria, we can see those PE ratios go up much, much more. For example, we were talking about last week with Tesla, which, by the way, we were on point about. Tesla has a PE ratio of 180. We saw a big sell-off just due to, they had a very poor earnings report. But we use the example that depending on how much you make per year, a PE ratio is a price to earnings ratio, meaning how much is this stock price compared to how much revenue and how much your earnings are reporting per year. 180 is 180 times that earnings. In this situation, UPS being at about 15 is considered a fair and actually quite a undervalued stock at this point. The main headwind that I imagine here is the tariffs with UPS. Did we see people slow down their buying? Do we see that impact their bottom line? And is it going to make an impact on that earnings for this quarter? So as you guys can see in the chart, we're just in this downward channel. We've peaked out underneath it, but made our way back into the channel, which is a good sign. We did fill this big gap from this pop back in 2020. So, there is a possibility we could see this head back up to the upside. Overall, we do see a bit of this, this sell-off, and it's taking that chop down toward the bottom in terms of this market cycle chart that we see. From what Stacks sees, this is everything. It shows all the sells as well, but if I filter just for the buys, you'll see how it really limits what's going on. There's really just 2 prints over the course of this last month. So if you're bullish, this one for September 19th, 105 calls, but keep in mind they only spent 90K on that. If this is a large institution doing that, that's just probably going to be a hedge in terms of things. And then in terms of the puts, the 542 is what really sticks out. That alongside with this April unusual print that we see for March, $70 strike, 120K, which is fairly small too, but that one's probably hurting right now because it's run up another $10 from that position. So equity, little sprinkle of buying here and there, but nothing that makes me say, oh my god, they're buying and they're trying to get as much of this as they possibly can. So what does Max have to say about UPS?
This one's interesting. They're divorcing Amazon.
Okay.
So estimated EPS here, we're looking at $1.38, down 8% year over year. Not great. Revenue, we're expecting 22.1 billion, and that's down 3.5% year over year. It's bearish, but this also may be bottomed out at this point. So that's one thing to consider during this report. They've dropped 50% since its peak in April, or not April, its peak in 2021, and it is now flirting with pre-COVID price levels. Wall Street's already priced in doom and gloom here, but zoom in and the story's changing. Operating margins are stabilizing, revenue per package is rising, and the Amazon breakup, it's long-term bullish. With earnings approaching, the big question is whether UPS has finally delivered a leaner model or if more pain is going to lie ahead. Now, what are we watching in Q2? Margin reset in motion. UPS is deep into a $3.5 billion cost-cutting campaign. That includes closing 73 facilities and slashing 20,000 jobs. In Q1, U.S. operating margins climbed to 7%, a 110 basis point year-over-year boost, even with volume being down. The translation, UPS is charging more per package and doing it more efficiently here. Now with the Amazon divorce, it sounds ugly in the beginning, but like divorce, some good always comes out of it. UPS is phasing out half of its Amazon business by 2026. That's a big hit. Amazon was 12% of its revenue back in 2024, but here's the kicker, it wasn't profitable. As CEO Carol Tomé put it, Amazon is our biggest customer, but not our most profitable. UPS is trading revenue for margin, and Wall Street might just respect that if Q2 shows continued strength without Bezos boxes.